Hello to all traders and welcome back to another live engagement with the non-farm payrolls for the month of August. We're looking at July's data coming in and it's supposed to be a little bit subdued. We had quite a good reading on the jobs data last time around. This time though, it's supposed to be a little bit less in favor, but we've heard that once before and we'll see if we're going to hear it once again. So once again, thank you very much for joining me. I'll be taking you through most of the main pairs and main commodities on the market. We'll go through a couple of slides, not too many, before I'm joined by my special guest, Daniel. So if you have any questions, the live chat is open and we will be going through any of the questions that you may have as well. So where is gold going? Where is the dollar going for the next couple of months? We've heard that the American economy has escaped a recession and it is in for a soft landing, but how soft will it be? Let me know if you can hear me properly. I believe everything is set up okay. Last time around, we had a couple of technical issues, but this time around, we are looking good at the moment. So thank you very much for joining me. And as I said, let's get right into it. As I said, take you through a couple of slides, not too many, just because it can get a little bit boring. As I said before, I'm joined by my special guest, Daniel, to review more of what's going on in the market. So a quick risk disclaimer before we get into it. So foreign exchange trading and investment in CFDs can be high expected and may result in losses as well as profits. Foreign exchange and derivatives trading is not suitable for all members of the public and only risk capital should be applied. This webinar is provided for information purposes only and no information contained herein constitutes a solicitation for the purpose of the purchase or sale of commodity, security or investment, nor should it serve as basis for any investment decision. All Limited does not guarantee the accuracy or completeness of any information and supply. So without further ado, let's just have a quick look at what we're looking at in the last time around. And you know, we were seeing a slight pickup in the last time around. If we look at this time last year, we had quite a good jobs data, over 500,000 new jobs added. And then during the holiday season for America, obviously there was a big rise in these new jobs being added. But since then, it's been pretty subdued, you know, under 500,000 every time, under 400,000 actually every time. And we're looking at now consensus as being just above 200,000 new jobs to be added, but obviously this could change quite dramatically as well. So we're just seeing what the next move is. As I said, well, consensus is roughly about 200,000. This could change momentarily. I'll just double check if it's been updated in the last few moments. No, 200,000 is still the consensus for this time around, and 209,000 last time. So, you know, we are looking likely that it probably will happen again. So I just want to take you through what's more important at the moment is the fact that the annual inflation has slowed down for a 12th consecutive month. If you think at this time last year, it was at 9.1%, and now it's at 3%. So the Fed really has worked quite well in taming inflation, getting it right down and making sure that it is looking at its 2% target by the end of the year, even though a lot of economists did think this was something that wasn't going to happen anytime soon. With the Fed hiking interest rates again for the highest in 22 years, between 5.25 and 5.5%. You have to wonder if there's going to be a terminal rate anytime soon for the Fed. It says they will have maybe one more interest rate hike by the end of the year. Their next meeting is on the 19th of September. So it has a few weeks to go yet to see where the economic data is going to lead them and if there's going to be any more of a change in their attitude towards interest rate hikes, or are they happy with inflation falling to 3%? They did say 2% is their target range. So let's see if they're going to get that as well. So very, very exciting times and interesting times for traders, because obviously more interest rate hikes means a little bit more progression for the dollar. And this is if the Fed's remarks are hawkish or not as well. So let me know what you think and where we're going to go from here. Are we going to have another interest rate hike by the end of the year, or is the Fed done with all this raising rates as well? So final slide, just want to, as I said, just wanted to look at what we're seeing in the near term as well and where we're going as well. So I just want to quickly share with you, well, not quickly, this is what we're going to be on for the rest of the session now, looking at the charts and seeing where we're going to go from here. So I'll just hide my face for now. As I said, I'm still here though. I just want to kind of zoom in on where we're looking at on the chart. So euro dollar at the moment, I just want to bring to your attention that we've had quite a slide in the euro dollar. You know, we've going from the mid 112 area, sliding right down over, well, 300 pips to the downside below 110. And now we are in the excuse me, lower regions of the 109. So is this going to pick up at any point? As you can see here, we are seeing now this bearish channel really progressing. And are we going to come out of it? This is the worrying thing from the euro dollar. There's been strong progression on the dollar, and we're seeing at the moment that prices are not looking really likely that they're going to start bouncing back anytime soon. The only thing that we could see is some firm support at the 109 level, which is only a few pips away, depending on this NFP data reading. So we are seeing roughly about here. We could see then a possible bounce and a move up. If we do see a move up, then I'll be looking at a full V-shaped recovery here to the upside, obviously. And this could, you know, if we do get some firm support, there's no reason why we can't have a kind of a 5-wave impulse to the upside, bringing us back up to the mid or even high end of the 112 level. So tell me what you think as well. As I said, questions are always readily answerable as we go into the first 5 minutes of the presentation before we get to the NFP. So just under 25 minutes to go before the main event. Also, just to let you know that unemployment data as well is expected to stay at 3.6%. So that's quite progressive for America, because we've been really going up and down from 3.4, 3.5, 3.6%. And this is really starting to get a little bit annoying for the American economy, because they're not really seeing any progression to the downside. MGI Capital just joining us. How is the outlook for the NASDAQ? We'll just have a quick look, actually. Just bring your attention to the Dow at the moment. I was just moving on to the Dow quickly on the 4-hour chart, and we'll move on to the NASDAQ shortly. So at the moment, we're just seeing what is quite a progression for not only the Dow, but the NASDAQ and the S&P. You know, we've had really good earnings season at the moment. We've had really progressive jobs data, and we are also seeing quite a big move up for most of the indices as well, including the S&P. So we are seeing quite a good run in that sense. Will we see everything? Well, we'll have to wait and see, but we are roughly seeing what is known as a bit of a spike in the indices as well. So I just open up the NASDAQ for you, and we'll just see where we are going as well. So just bear with me one moment. So as I said, with the Dow, with the NASDAQ, with the S&P, we are really seeing some progressive moves. It's not only in the European stocks, in the American stocks are really flying as well. Really, really looking likely that we're going to have more of this move to the upside continuing for most of the time as well. So at the moment, we're just seeing a progressive move, waiting to see where the next move is as well. So let's just take a quick look at, so we've got, as I said, this kind of bullish approach for most of the indices. Just make the screen so monitoring. So CK Frank, thanks for joining me. Which instruments are we monitoring on this coming news? So just got to look at the major pairs: euro dollar, dollar yen, Dow, NASDAQ, sterling. We're also going to look on gold. Gold is quite a big favorable commodity for our clients as well. Always get questions about gold, because obviously it gives us a bit of a direction on where the dollar is going as well. So this is where we're looking at in the near term as well. So I just want to pull this back quickly for the NASDAQ for the daily chart, because we're just seeing now, so I've got a 4-hour chart, we're just seeing now this big progression in the movement for the Dow and the NASDAQ and the S&P. Just quickly look on gold before we go delve too deep, because gold has got a question on which direction gold is going to go. Well, as you can see, we'll just go on the 1-hour chart, because I just want to show you at the moment the depreciation on gold. So, you know, since we had a bit of a run up to the 1985 level, we are seeing now this really, really big sell-off in the market back down to 1930. However, we've had this double bottom at 1930, which we are currently trading at right now. So if we do start moving further through 1930, I can easily see 1900 being tested possibly by the end of this session. It's not really out of the question that $30 are going to be wiped off gold by the end of this session here. Obviously 1900 was the last time we saw firm support before we had a bounce back up to 1985. So we've had this kind of really big impulsive move to the upside, and as you can see, this kind of bearish impulse wave back down to the downside. So we are expecting pretty much a kind of move in this degree and then back down to 1900 if we do get a strong NFP reading. But even if we don't get a strong NFP reading, it seems to be like bears have really settled in on gold, and they've started moving lower as well. So this is really starting to see that we are in the midst of a really bearish move for the yellow metal, because it's looking likely that will keep on moving lower as well. But tell me what you think. Are you trading gold yourself? Are you looking at the metal market, silver as well? This is really something we are looking at the moment as well. So we'll have to wait and see if that's going to actually start moving to the downside. So just getting back to the NASDAQ, just put the 4-hour chart on here. So at the moment, as I said, let's go on the daily chart, because as you can see, the momentum for the NASDAQ is really, really pushing higher. We are expecting a slight correction in the markets, but it doesn't mean that it will start collapsing quite significantly. We've had this really bullish run. If you think from just roughly about just under 11,000 up to over 15,000, such a big move in the market. And this isn't just for the NASDAQ, S&P as well, really, really bullish at the moment, but taking the same line as the NASDAQ, as you can see here, in a correction now, dropping off quite a few points. So this is what we're looking at, and to see if there's any big opportunities in the market. Obviously, with every big bull run, we are expecting a slight correction, but as you can see here, we did get a slight correction here, but it didn't last for very long. And now we are looking likely that it will probably do the same kind of movement here. So bullish run here, slight bearish sell-off here, which is natural because obviously the market can't keep running a bull market forever and ever. And then again, another move to the upside. So if you think the last time we saw these particular levels, it was quite a while ago. If we go on the weekly chart, we're looking at the end of 2021, December, before we had this bullish sell-off. But as you can see here, if we look on the weekly chart, if you are a long-term trader, very nice progressive V-shaped recovery here to the upside now. And, you know, it could easily start moving back up to the pretty prices of the 4,800, 4,900 level. So this is what we're looking for at the moment. So very interesting times on the S&P, and it'll be pretty much the same as the NASDAQ as well if we leave it on the weekly chart. As you can see here, progressively higher, and obviously on the Dow, we're just seeing that we had it on the chart earlier. We're just seeing now more of a progression. So just keep an eye out. If you are a long-term trader, you know, it is actually playing out pretty progressively and quite predictable as well. That's a good sign if the market is a little bit predictable. But obviously, if you're a day trader, just wait for these kind of slight corrections. If we go back on the hourly chart for the NASDAQ, for example, as you can see here, on the hourly chart, it looks like a bigger correction than what it does on the weekly chart. So just keep an eye out for that, because it can be a little bit confusing and a little bit worrying, actually. But we are expecting after this particular area to have another progressive move to the upside, which it has begun here actually on this particular area. So let me know if you want me to look at any other particular pairs. I'll just keep moving on the assigned pairs at the moment. Just want to look at dollar yen. Dollar yen on the 4-hour chart, we were looking at this kind of expanding triangle moving to the upside, but we'll see how far we get there. So I've just been joined by Daniel now. Let me just let him in. Hi, Daniel. How are you doing? Can you hear me?
Hey, sorry.
Hi, can you hear me okay, Daniel?
Yeah. I think I had my my headset off for a second there.
Okay, well, at least it's working. And you,
Yeah.
So thanks for joining me again, Daniel. I'll just informing our viewers of quite a pickup in Well, let's say the Fed's long game, because it did have a target of 2% for the inflation. We're down to 3%, which, if you think of this time last year when it was at 9.1%, it's quite extraordinary, isn't it, really, that the Fed's long game has actually come into fruition. And even though these rate hikes have kept on persisting, the Fed is actually in a place where it can kind of relax a little bit now.
Yeah, that seems to be the thing, and it seems like it's finally working. That they're getting closer to target. Though of course, everyone's kind of worried that it's going to be hard. The closer they get to the target, the more hard it's going to be to complete it. But yeah, it seems to have worked, and so there might have been people at the beginning who were a little bit doubtful, but it seems they're getting there. They're almost there. The expectation for next week, when we get the CPI number, is for it to go down another 2/10, so it'd be down to 2.8%.
Yeah.
So it's getting closer, but of course they still have the issue with the core rate is still high, so that'll take a little bit longer and a little bit more work. So that's why the Fed keeps saying that they're going to raise rates again.
Mhm.
The market also thinks that they still have that disagreement, but the thing is, between the Fed saying what they're going to do and what the market says what they're going to do, kind of you would expect the Fed to know what the Fed is going to
Yeah.
do more than the market, and there's that.
Well, yeah, because we did say that a few months ago there would be a terminal rate of roughly about 5%. Now we're going towards 6% for the next rate psychological area, let's say. And they've got another meeting, I believe it's September 19th, approximately.
That's
So
right.
they did say there could be in for one more rate hike before the end of the year, possibly two. So do you see that as something realistic, because they are looking at a soft landing now, to be moving out of a recession? Well, not, they didn't get to a recession, but they're supposed to avoid a recession and have a soft landing. So because of this, we could be in for a couple more rate hikes, couldn't we, before the end of the year?
Yeah, yes. The thing is, if there's a recession coming, then of course they're not going to be able to raise rates, and so if there's a soft landing, then they have more room
Yeah.
for it. But the other thing is that now in August, when they go on something of a vacation,
Yeah.
they had the Jackson Hole Symposium, and usually that's when the heads of the ECB and the BOJ and the BOE all get together, and often they change their perspective. So last year, they when they got together, it was sort of like, well, we got to start raising
Mm.
rates, and now they'll get together and say, well, you know what, we've done, it's going along pretty well, so we're not gonna keep raising from now going forward. So these kind of like, it particularly depends on what the data is going to happen in here until the Jackson Hole, and then that might be the opportunity for them to sort of suggest that they're not going to keep raising. So they've been saying they're going to raise, so there's that possibility, and then of course there's a possibility that they'll use Jackson Hole as a springboard for saying, yeah, we reached the point where we're going to go flat from now
Yeah.
on.
Well, like you just touched upon, it's a case of, if they do see a recession coming, they might start raising rates before it comes. So they have an excuse to
Yeah,
do
so
it.
that they have
They have
something to
something
cut.
to cut. Yeah.
Yeah.
So yeah. So it's basically a little game of cat and mouse at the moment, because they did say in the last meeting they will wait for each economic data month by month to see what the landscape is, and then they'll talk about raising another rate again. So at the moment, it seems a bit subdued. I think a lot of people are just waiting in anticipation if we're going to see another rate hike. But the Fed are really trying to approach this 2% inflation target, because that's what they set out on last year when they
Yeah.
really started aggressively raising rates as well.
Yeah, they're really committed to it. Unlike, for example, the Bank of England, which has been having a little bit of difficulty getting their interest rate
Yeah.
down. So it seems like the going hard at the beginning and aggressively seems to have worked. Unlike, other central banks, where the ECB waited for a long time to start hiking, and then they hiked
Mm.
aggressively, and then you had the BOE, which started, but then they were really slow
Yeah.
about it. So it seems like the Fed has done pretty well in getting the inflation down faster than pretty much everyone else. And then of course you have the situation that happened with Canada. Canada got their inflation down a little bit faster, but they have like a slightly different situation. And then the inflation rate started going up again. So then they had to start raising rates again after they started their pause. And so I think the Fed might be really worried about that, because they would kind of lead them to feel like they're losing a bit of credibility because they say, well, we're going to start pausing now, and then and then inflation goes up, and they're forced to raise interest rates. So they might try to go. That might be why they would actually go for another rate hike, say in September. Is not necessarily because they think it's
Mhm.
necessary at that point, but they want to make sure that it won't be necessary in the future. Because one of the things that's happening is because of base effects. If the inflation rate keeps going as it is now, the annual inflation rate will start going up because there was such a large increase in inflation during the last period. So even though inflation is coming down at the current moment, it might start showing up in the statistics as going up. And so that might be another reason for them to also go ahead with another rate, or maybe even two, as you mentioned,
Mm.
before they finally call it
Yeah,
quits.
well,
But, so
like you
yeah.
just touched upon, I mean, the UK central bank and the European central bank, Turkish central, all the other central banks around the world, they were kind of waiting to see what the after effect would be from the Fed starting first, aggressively raising rates by 75 basis points. I think they were waiting to see, like, oh, let's see if this works out, and then we'll start
Yeah.
raising rates. So, but because they were slow off the mark, it seems that the Fed have really finished the 100-meter sprint, let's say, and all the other central
Yeah.
banks are just like, catching up behind.
Yeah, there are some that are sort of already starting to cut, but they like have specific issues. Like Brazil,
Yeah,
they're cutting because they have their internal problems, and also Chile, they were extremely aggressive at the beginning, and then they had the whole,
yeah,
internal political thing. So that's why they're also among the first to cut. But it seems like it's going somewhere in this year, at the end. The next couple of months is going to reach the peak, and then they start turning around and going to the other side.
yeah.
Now the question is whether they're going to start gradually tapering the interest rate down because the situation is normalizing, or they're going to cut the interest rate because there's a recession going on, and there's some kind of financial crisis. Because traditionally, most financial crises happen around September, October. The last one was in March, but that was kind of exceptional because of the pandemic.
Yeah,
But then prior to that one, it started in. You had the big crash when it was in September, and the one previous to that, the dot-com one, was in early October, and so on. So you might want to be a little bit nervous until September and October are over before
exactly.
we can really say
Yeah,
something to be too safe.
exactly. And then hopefully by then the holiday season would kick in for America, and then they'll have a lot more
Right.
jobs to be had in the market as well. I
Yeah.
just got a question about gold, Daniel. Just quickly answer it. So
Oh yeah. Always the gold is always
it's
a good
always a good
question.
question. Yeah. So just before you came in, I was just looking at a slight prediction that I was looking at, because we've had such a sell-off in gold since it hit roughly about the 1985, 1990 level a few weeks, well, not so long ago actually. We're just looking now that because of the sell-off back down to 1930, it could actually keep on pushing lower to 1900, because the 1900 level was the last time we saw support, and then a move back up to almost 2000. So it looks like a bit of a zigzag move at the moment. We're having this kind of progression, full force back up to almost 2000, and then a big sell-off back down to 1900. So, I mean, I'm looking at a bit of a double bottom at the moment, and at the
Right.
trading moment, that way we are, but roughly about 1930. If we do break that, I can see a bit of a zigzag kind of impulse back down to 1900. But we'll see on obviously the jobs numbers, and it won't affect gold too much, the jobs numbers, because we are looking likely that only 200,000 new jobs will be added, which is still quite progressive. But compared to the previous months where we've had over 300,000, we could be slightly subdued. But we have had some shocks in the last few months, haven't we? When we saw
Yeah.
quite
These major surprises.
exactly, and obviously with the NFP, we love surprises because it moves the market a bit more. But where do you
Yeah.
see the jobs numbers for now, Daniel? I mean, obviously, like we just touched upon, Thanksgiving periods and holiday periods in America, we do get the natural progression of higher jobs numbers. But at the moment, just coming into the summer period, and obviously going towards the end of the year, where do you see the jobs numbers going, and unemployment data as well?
Well, there's a little bit of a hiccup portion here because during the summer you have a lot more travel and you have a lot of seasonal jobs
Yeah.
that sort of pick up in the
Mhm.
summer, and then of course you have the other seasonal jobs that pick up towards the holidays, as you mentioned. So usually by the end of August through September and October, this sort of like actually October you start getting Halloween. So it's pretty much September you get this sort of like blip down, which is seasonally adjusted for in the data. So it shouldn't really be a significant move. But the thing about is that you still have this big gap between the number of jobs that are open and the number of people that are looking for jobs. But it keeps coming down. So I think in the last one it was 9.6 million, and there were 6.4 million-ish people who are looking for jobs. So before it used to be 5 million people looking for jobs and 11 million jobs open. So the number of jobs is coming down, and so that has been creating the distortion and why you keep getting these surprise numbers. And so as that normalizes, the distortion should probably go away, and then you might see the jobs numbers start turning around. The question is, at what point is always the timing is always the big issue. You can say, well, like it's like a recession. We know there's going to be a recession. We just don't know when.
And effectively, America have avoided the recession, so it seems to be okay.
Yeah.
But Daniel, we've touched upon this before. Like before the COVID pandemic, 200,000 to 300,000 new jobs being added every month. It was quite a progressive employment
that would be considered a good number, and you'd probably get a jump up in the market after it. So anything, if it was below 100,000, then people will start getting worried. The thing is, in order to, they're still missing a certain number of jobs. Sort of like the total number of jobs is above what it was in the pandemic, just before the pandemic, but the number of jobs that would have been created if the trend had continued is still about 3 million short, which is why you still end up with this gap of about 3 million open jobs versus the number of people who are looking for jobs. So in order to cover that, you'd be expecting to see job creation numbers in the 400 to 500 range, but that really isn't happening. So even though 200,000 is usually a good number, still in the context, it might not exactly be a good number. But the thing is, that really doesn't matter, because the market is going to react on the basis of what it thinks. And so if it thinks that 200,000 is a good number, then it'll probably just pop up, even though there might be a whole bunch of economists saying, hey, actually maybe it isn't so good, but if the traders want to trade it up, it's going to go up.
Yeah, exactly. And another thing, just touching just under 3 minutes to go into the news, but the US indices have been so progressive in the last few sessions. The Nasdaq, Dow, S&P really on a bullish trend, and doesn't look like slowing down at the moment. We've had such a good corporate earnings season at the moment. Do you see any kind of slowdown? I'll just put the Nasdaq on the main screen as well, because on the if we just put it on the 4-hour chart, we're having a slight correction at the moment, but of the three major indices, we're seeing such a big progression at the moment. Do you think we're going to have a huge correction sometime soon, or do you see it to keep playing out?
Well, that seems to be the thing, because right now you had, the Fitch downgrading the sovereign rating of the United States. It was back on Tuesday. That put a little bit of risk in the market. That helped with the correction a bit. But the general trend was, the consensus among most economists is that it's just going to be a blip, and then it'll recover. So maybe next week the upward trend will return. And so since the earnings season has been so good, we had about 80 of the companies that are reported, over 80% of them have beat estimates. So that's generally usually seen as a good sign that the stock market will keep going up. But again, we also have this problem of breadth, that it's only a few stocks that are moving higher, and then the majority of them are actually still moving lower, but because of tech. And so it's really AI that's pushing the market. So there doesn't seem to be anything going against AI at the moment. So it'd be, as long as that keeps going, you probably might get a rebound, particularly in the Nasdaq is a really good example there.
Exactly. So we're just under 1 minute away. And just to touch on the AI stocks, I was asked a couple of weeks ago, is this just another boom like the dot-com bubble? But it can't be, can it? Because AI is the future. It's not like, dot-com, we're just going to invest loads of money into these companies and it's just going to blow up. Apple, Microsoft, all these big corporations, they're here to stay. It's not as if it's just a couple of years.
That's the thing. So the dot-com also was it was about the internet, and the internet was here to stay. So you get this, a new technology can lead to a certain amount of euphoria at the
Yes,
beginning, and so you get like a bump up, which at least a bit of a bubble, and then it gets corrected back down to sort of a
exactly.
normal level, and then starts growing out. So that might be what happens with AI, just as sort of what happened with, well, I mean, you had the shares of Google and Amazon, and all those had a bump up in late 99, 2000. They had their correction, and then after that, they've gone up parabolic or significantly higher than they were back in, at the peak of the bubble in
Mm,
2001. So, you just, again, it's a matter of timing, which is always
exactly.
the bugaboo for anyone who's trying to trade.
Exactly. So the NFP numbers just coming in now. So 100,
Oh,
187,000 new jobs being added for the
oh,
NFP.
yeah.
So, it's a little bit under the consensus of 200,000, but not too much out of the way.
Yeah.
So we could get a little bit of a weak dollar at the moment, as you can see on the euro dollar just spiking higher, the gold just coming high. But I don't think we're going to have such a big move because it wasn't such a big shock. Also looking at the unemployment rates dipped to 3.5% from 3.6%.
Oh, yeah. Another one of those split
Yeah,
thing.
split decisions. Yeah, like, oh, we've had, we've
Yeah.
had this figure on the NFP, but we've had this figure on the unemployment rate, so it could balance out.
Yeah.
Yeah. So, but we're still seeing a little bit of a weak dollar at the moment, but not too much in the way of big movements. Let's just see, euro dollar just moving just over 20 pips, 25 pips. So, not too much in the way. Gold moving from 1930 to 1935, 1936. So a $5 to $6 move there. So just to digest all the other information. Also, another thing to touch upon, Daniel, we've got the unemployment rate from Canada as well, and the unemployment changes. So
Oh, right. Yeah.
uh,
Everyone forgets that one.
exactly, yeah, we kind of like skipped that because we're just so focused on the NFP. So, but yeah, Canadian news obviously affects the loonie as well, the dollar CAD. Not too much in the way of
Yeah.
this time, though, just having just a few pip movements, but it's gone back to parity at the moment from when it started. The only one that's really moving, euro dollar cable, just 20 to 30 pips. But I mean, most of the time when we get a bit of a non-performing payroll, we do see price action just kind of go back to where it was, don't we? Most of the time.
Yeah, you get the algos go in there and then move because there's, oh, miss, on miss they go and then start selling, and then after a while then the traders come in and say, yeah, but it wasn't all that much of a miss, and then of course it depends on the revisions, which is what I'm waiting to see.
Exactly.
That
Yeah.
can change it a
The
little bit.
revisions are quite funny because when I started trading on the NFP, I'll be like, oh wow, it's this number. And then after like a little bit of time,
Yeah.
it's like, oh no, actually it's this number. And that's why the market's been affected like it has been. So yeah, it's just for all of our traders and
Yeah.
viewers out there, just be careful for the revision because it can actually affect you can have little ripple effects in the market for the rest of the session if you are trading that far ahead. So Daniel, so coming up to the Fed's next interest rate hike, potential interest rate hike
Yeah, potential.
next month. If there is another hike, I mean, the Fed is only going one way now. I think it's determined to get this 2% target, and obviously it will keep
Yeah.
on going until it can't go anymore. So we're at the highest rate in 22 years now, pushing up to almost 6%. Is this a cause for concern in the long term for the American economy? If you think that, are they going to start moving rates down at some point, and what would be the aftershock for that, since we've had 2 to 3 years of progressive rate hikes at the moment?
Yeah, well, they're sort of committing to keep the rates higher for for quite a while after that. There might be a little bit of adjustment on the downside, but it depends again on what happens, whether the adjustment has been too high. Though, just one thing that I noticed here with the not the NFP, the hourly earnings
Yes.
is a little bit above expectations,
Okay.
and that puts inflationary pressure on it. So that would might be leading people to think that the Fed, that would put a little bit more inclination towards the Fed raising rates a little bit. So of course we still have to wait for the inflation data to come out next week. But that's again another thing is what's going to happen with inflation. Is it going to start trickling back up? Because it's a lot easier to, if you move down from 9 to 6%, that's a really big move.
Yeah.
But once you get down to 3%, a 3 decimal move is a 10% of the total amount. So it's you can get smaller fluctuations, then become a bigger problem, kind of thing. And so then you might end before the Fed was reacting to a 2 or 3% change in the inflation rate, and then now they're going to be starting to react to 3 or 4 decimal
Yeah.
change in, and so you could end up being a lot more intense, I guess would be a way of saying it. And then of course they have the concern that everyone has, is that the Fed is going to raise rates too much, and that's going to push one of one of the problems that you have with the housing industry is that people aren't buying
Yeah.
houses because the mortgages are way too expensive, and so that is going to weigh on the economy. And people are borrowing money to because they need to go through their usual expenses. Credit card, the interest rates they're paying on their credit cards is significantly higher, and the number of people that are using credit cards is increasing. So keeping the interest rates higher or pushing them higher could end up causing the recession. So it might be that the Fed will raise rates up and then maintain them for a few months and then start pulling them back down slowly in order to reduce that effect and try to get the economy to move a little bit faster. Because another thing is next year is an election year, and usually the government spends more because all the politicians are trying to get
Yeah.
reelected, and so then it's less common. It's not to say it's impossible. It's usually less common for there to be a recession because there's that buildup of extra spending. And of course, the Fed doesn't want to be seen as doing something too out of the extraordinary during an election season, and so they're going to try to want to maintain the interest rate a little bit more balanced. Right now, they don't have sort of the political cost to go out there and say, "Hey, we're going to really clamp down on inflation," and then next year, then they can lower the rates down to maybe say 3 or 4% instead of being at 5%, because then of course you have this whole thing because of the Fitch downgrading, said because of the high debt, right? And so the federal government's interest expenditure is now reaching close to $1 trillion, which is more than they spend on defense, which is starting to be a kind of a big problem. Because and as long as the Fed keeps the interest rate high, the amount of money that the federal government is spending on interest to pay off its debt, to pay for its debt, is also going to be high, which is going to crimp the budget, which is going to increase the deficit. And so then it starts becoming sort of a fiscal negotiation between the Treasury and the Fed. And of course, the Secretary of the Treasury is a former head of the Fed, so they kind of get along really well. So it's also understandable that they would have really good coordination in dealing with that. So you also have that the federal government is now going to bring out $1 trillion in new debt over the next 3 months, and then after that another $800 billion. So that could also push up interest rates, which has the same effect as having a rate hike, even if the Fed doesn't do anything. So if the interest rates start creeping up because the government is putting out all this debt, then the Fed might find it convenient to start cutting rates, sort of to offset the effect of the increased interest rates that are the product of the difference in supply and demand when the federal government puts out more debt, because they're spending a lot of money, and they're going to try to spend more money next year because it's an election year.
Exactly. Yeah, it's like a big merry-go-round. And also, like you
Yeah.
said, most of the Democrat and Republican nominees are probably going to just talk about, cutting cutting taxes and everything. So we could see a little bit more cash being moved around in the American economy in the lead up to the to the voting procedure for the Republicans and Democrats.
Yeah, that's why a lot of people think, or I guess I'm kind of sort of in that camp, but I try not to provide any predictions
Yeah.
because predictions are hard. But it's sort of like if you get through October, really, then probably the recession thing has been mostly averted, because starting, that's also October is when the new fiscal no. September is when the new fiscal year starts, and so there's going to be a new budget. And of course, both the Democrats and Republicans agreed to suspend the debt limit, which means they can spend as much money as they want up until the election. So both sides do want to spend more to bolster their political support. So we could see, but then of course the problem with this increased spending is that you then have the risk of more inflation going forward, which would then presumably require the Fed to raise rates again. So that might be another reason for the Fed to raise rates now, to get inflation down as much as possible, so that next year they don't have to be raising rates. Then as inflation creeps up, then after the election they can start raising rates again, and so then that sort of balances out their fiscal responsibility
Exactly.
thing with the political responsibility thing.
And the
So
and the merry-go
it's all speculation.
and the merry-go-round keeps on going, basically.
Yeah.
Okay, Daniel. Well, that's great. Thanks for your informative perspective on the markets, and obviously going forward as well. It's not only today's NFP. Obviously, it's nice to get an outlook on not only the rest of the year, but obviously we delved into next year as well, and the potentials on where the market can go as well. So it's very, very interesting. So thanks for joining me again this time around. And
yeah, thanks for the invitation.
No, pleasure is all mine. And thanks to our viewers for joining us. And we'll see you next time, Daniel. Thanks a lot.
Oh yeah, take care, everyone. Happy trading.
Thanks a lot, Daniel. Take care. We'll speak next time.
Right.
Bye for now.
Okay. Yeah. Bye.
Okay, so that was Daniel joining us, and so just to get his perspective. So let's just take a look on where we are with the charts at the moment. So we'll delve into each one to see just how effective that NFP was. So the euro dollar at the moment, as I said, going up to the mid regions of the 109 area. So we've moved roughly about 40 to 50 pips. Will we get this rebound at the moment? Let's just delve in a bit more. So let's go on the 15-minute chart just to get more of a outlook. So this whole spike from the NFP time moved up roughly about just over 40 pips. We've retraced about 4 or 5 pips after that. So, roughly about the high end of 30 pips that we've moved for the euro dollar. So not a bad progressive move. However, at the beginning of the presentation, we looked on the 4-hour chart to see if there's going to be this firm support and a move higher. At the moment, it seems like it's playing out, but we do have a long way to go for the euro dollar because it has been quite a progressive dollar, greenback, whatever you want to call it, for the last few weeks, going to starting from kind of the beginning of this month, so the beginning of July. So about 2 or 3 weeks ago, we were seeing quite a progressive dollar. That's why we saw such a downshift in the euro dollar. So I'll be looking to see a kind of a bounce at the moment, and then looking to move back up to the upside, especially if we're looking at this V-shaped recovery. So nicely played out at the moment. Let's move on to gold. So gold, we've had roughly about a $7 to $8 move on gold. We're trading roughly at it's just moved over $10 now. So let's go to a 15-minute chart just to see where we're looking at. So we were having this heavy consolidation, and it was looking likely that we were going to stick in this. And as you can see here, we were actually on the lower end, but as you can see, we have actually broken that now. We were roughly about the 1936 area to be broken. We've broken that by a few dollars, moving up to 1942 now. So that's actually quite progressive for gold, looking likely that we will see a slight rebound on the yellow metal, but how far will it go? I'll just be still looking at this consolidation level to see if we're going to be moving out of it completely, or if this is just a slight false break, which we can get with these high impact fundamental news events. So just be careful of that if you are trading gold for the rest of this session as well. Moving on to dollar yen, we were just touching dollar yen before Daniel joined us, and I was just looking on the 4-hour chart at the moment because we were seeing this, again, V-shaped recovery. It has actually taken more time than the move to the downside. As you can see here, very, very progressive, bearish move to the downside. We are seeing a slight move higher now, but we could get caught out with this kind of bearish expanding triangle that has hit the market in the last few trading sessions. So if that does happen, we could see possibly more of a run through that. So something just to keep an eye out for as well as we go into the third quarter of the year. So very exciting times, even for the dollar yen as well. Just another look on the NASDAQ. Again, I'll just be seeing it had this really big push. As you can see here, it's pretty much ended up as a doji candlestick at the moment. And I'll just be seeing that, well, anticipating that the Dow, the Nasdaq, and the S&P will keep on progressing higher, especially with the strong corporate earnings seasons as well that we're really looking at as well. So looking at the dollar CAD, the loonie has really been, well, it's actually moved to a doji now. It was actually progressing higher, but it has pretty much started to retrace quite significantly. Let's just zoom in on the loonie because I just want to show you how much of a volatile state we were in. So we've moved up quite progressively, roughly about 50 pips to the upside, and then we collapsed quite significantly, roughly about 30 pips back down to the downside as well. So this is something that we'll be looking at in the near term to see if we're going to have this remaining doji happening on the 30-minute chart or on the 1-hour chart, or if we're going to have a move back higher as well. And also on sterling, I didn't really get to look on sterling so progressively, but it is really playing out a little bit like the euro dollar. Not something too surprising for sterling because we had a bit of a weak dollar. So naturally, we had a move to the upside. And it's looking likely that this could have some firm resistance now, because this was the last time we had this particular level, roughly about the mid 127 handle. So this is just a few of the main forex markets that we'll be looking at. Obviously, gold as well is something we always progressively try to look at because it is quite nicely balanced at the moment. So we are still in the midst of this potential soft landing for the Fed, and we are now seeing that we could get more of a progression on the dollar as we have another potential interest rate hike on September the 19th, and then we could have, we could see more of a sell-off on gold as well. So we had gold as a firm support on 1900 a few weeks ago, shot up to 1990 roughly. Now we're moving right back down to 1930 trading at the moment, 1940 with the spike today, and then we could start moving back down to 1900. So these are the main movers of the market at the moment. I'll be online a little bit longer if you have any questions, but for now I'll be saying goodbye to you. The NFP has come to an end for another month, but very exciting times. Obviously, this time next month we'll be gearing up for a potential or another interest rate hike, and we'll see what the other central banks think of in the next the next half of the year. Obviously, we're moving into August now. We haven't got that many more months until the end of the year, so we have progressively crossed the halfway line, and we'll be seeing if there's going to be any more movement to the upside as well for the dollar. So let me know what you think in the comments. Feel free to check out my LinkedIn profile. Feel free to join me. Ask me any questions you need to on there, and we'll be able to connect. And if you have any trading questions or you need any assistance with trading, please let me know. We can go through it together. And obviously here at Orbex, we are always looking out for the next big movement in the market, next big surprises, and where we're going to go from here. So thank you very much for joining me once again. And as I said, any questions you have, please feel free to connect with me on LinkedIn or put your message in the chat box here, and I'll get back to you as soon as possible. So have a great trend day ahead. Have a great weekend ahead coming, and we'll speak again next time. Bye for now.